Hey everyone, welcome back to Corporate Decoder. Today, West Pharmaceutical Services Inc. WST just filed its quarterly report, and I'm seeing some big moves impacting their bottom line. Quick note, this is not financial advice, just my take on public filings for educational purposes. The company is showing impressive sales growth, but there is a noticeable dip in profitability at one of its key business units. Alright, let's dive into what West Pharmaceutical Services Inc. is telling us in their latest report. This is their Form 10Q, which gives us a look at their financial health for the quarter ending the 30th of June 2026. Right off the bat, the numbers for net sales show a strong upward trend. For the 3 months ending the 30th of June 2026, West Pharmaceutical Services brought in $872.3 million in sales. That is a solid jump from $766.5 million in the same period last year. For the first 6 months of the year, sales hit $1.7 billion, up from $1.4 billion last year. This shows their products are in high demand. Looking closer at the breakdown, their proprietary product segment is really driving this growth. Sales in this area jumped by over 16% for the 3-month period and nearly 20% for the 6-month period. This success is thanks to strong demand for their high-value product components, especially those used for biologics and GLP-1 drugs. They also saw a big boost in their high-value product delivery devices, with sales of their SmartDose 3.5 ml system performing particularly well ahead of a planned sale. However, their other segment, West Vantage, which handles complex device manufacturing and assembly, saw much slower growth. Sales there increased by just 2% for the quarter and about 6% for the half year. They even mentioned that their sales growth was negatively impacted by about $7 million due to production downtime from a cyber incident in May 2026. This shows a vulnerability in that part of their business. Now, let's talk about profitability. While overall sales are up, the gross profit margin tells an interesting story. Consolidating everything, the gross profit margin improved to 37.7% for the quarter, up from 35.7% last year. This is great news overall, but the West Vantage segment's gross profit margin actually decreased. It fell to 14.2% from 17.5%. The company attributes this to inefficiencies from the cyber incident and rising costs, which were only partly balanced by price increases. This is a red flag for that particular segment. Spending on research and development remained pretty steady, around $19.7 million for the quarter. This indicates a consistent investment in future products, which is generally a good sign. All of this R&D spend is within their proprietary product segment. Selling, general and administrative costs, or SG&A, increased substantially. Overall, SG&A costs went up by about 22% for the quarter and 18% for the 6 months. A big driver of this increase was their corporate and unallocated expenses, which include things like recurring professional fees related to legal matters and the May 2026 cyber incident, plus costs associated with the sale of their SmartDose system. These unallocated costs are where a lot of the surprise comes from. For the quarter, they were $39.8 million, a big jump from $27.4 million the year before. This includes $6.9 million for non-recurring professional fees due to legal issues and that cyber incident, plus $5.1 million for services related to the SmartDose sale. Other expenses also played a significant role. The company reported $12.8 million in other expenses for the quarter compared to just $5.2 million last year. This increase is largely due to higher contingent consideration expenses, meaning they might owe more based on future events and losses on oil hedges. Digging into those unallocated costs further, the company faced charges related to their January 2025 restructuring plan and specific costs tied to the sale of their SmartDose system. They also recorded $3.5 million in impairment charges on cost method investments. These are one-time or unusual costs that can impact the short-term picture. When you look at the operating profit, the overall picture is positive. Consolidated operating profit increased by about 16% for the quarter. However, the West Vantage segment saw its operating profit decrease by nearly 28%. This was mainly due to the inefficiencies I mentioned earlier from the cyber incident and higher plant costs. If we look at their adjusted operating profit, which tries to strip out those one-time or unusual items, the margin still improved to 22.6% for the quarter. This suggests that the core business is performing well, even with those segment-specific challenges and higher corporate costs. Interest expense net was $2.6 million for the quarter, a big jump from just $0.1 million last year. This rise is mainly due to less interest being capitalized, meaning fewer internally funded projects are generating interest that is added to the asset cost, and more being expensed. Their effective tax rate was 17.9% for the quarter, down from 19.2% last year. This is partly due to favorable changes in where their earnings are generated. However, for the 6-month period, the effective tax rate increased to 21.3% from 20.3%, mainly because of a one-time $12 million tax cost related to an internal legal entity restructuring. The company also reported equity and net income from its affiliated companies, which increased. This is good news as it reflects better performance from their joint ventures and partnerships, particularly with Daikyo in Japan. Now, let's consider cash flow. Net cash provided by operating activities decreased by about $92 million for the first 6 months of 2026 compared to 2025. This drop is attributed to changes in working capital and higher incentive payments, though improved operating results did help offset some of this. Cash used in investing activities also decreased, mainly because they spent less on capital expenditures. This means they are slowing down investments in new equipment or facilities compared to last year. On the other hand, cash used in financing activities more than tripled, jumping from $161.9 million to $473.5 million. The biggest reason for this increase is a significant rise in share repurchases. They spent $454.3 million buying back their own stock in the first 6 months of 2026. This heavy investment in share buybacks, along with capital expenditures, has led to a noticeable decrease in their cash and cash equivalents. The balance fell from over $791 million at the end of 2025 to $435.8 million by the 30th of June 2026. Consequently, their working capital also decreased. It went down by over $156 million. This is largely due to that significant drop in cash, even though accounts receivable increased. Their total debt of $202.9 million remained pretty much unchanged from the previous year. They also have access to a large revolving credit facility with over $497 million available, which provides a good safety net for liquidity. Looking at their balance sheet, total assets are down slightly to $4.1 billion from $4.3 billion. This is partly due to the decrease in cash and a slight dip in property, plant, and equipment. On the liabilities side, total liabilities are roughly the same, around $1.1 billion. However, equity saw a notable decrease, falling to about $3 billion from $3.2 billion. This is mainly a consequence of those large share repurchases, which reduce the equity on the books. One critical risk factor they highlighted is the ongoing threat of cyber attacks. They specifically mention a material cybersecurity attack in May 2026, where data was exfiltrated and some systems were encrypted. This incident temporarily disrupted their global operations, while they say operations have fully recovered. The mention of exfiltrated data and ongoing sophisticated attacks is a serious concern. This is similar to what happened to Clorox, but West Pharmaceutical Services seems to have recovered faster. In terms of leadership, they filed an executive employment agreement for Michel Lagarde dated May 31, 2026. While the filing does not detail his role, such agreements are typically important for key leadership positions. In terms of insider trading, a net F favorite, a senior vice president, adopted a Rule 10b-5-1 trading plan in June 2026. This plan allows for the exercise of stock options and sale of up to 15,659 shares of common stock. While this is a normal process for executives to diversify their holdings, it is worth noting. So, what is my take on all this? West Pharmaceutical Services is clearly seeing strong demand for its core, high-value products, driving impressive sales growth. The overall financial health appears solid with improving margins and good access to credit. However, the underperformance and margin declined in the West Vantage segment. Combined with the significant impact of the cyber incident and increased corporate costs are definite areas to watch. The aggressive share buybacks are also reducing their cash buffer, which could be a concern in uncertain economic times. The risk I am watching is how effectively they can turn around the West Vantage segment and recover from the cyber incident without further operational disruptions and increased costs. The research tools I actually use are linked in the description. They help keep this channel going. That is my take. Stay decoded if this analysis was valuable. Hitting that like button really helps. And subscribe for more deep dives. Don't forget to check out the Discord in the description.